PMI stands for private mortgage insurance. It is required with what we call conventional loans, which includes the 30-year fix that most borrowers prefer today. If you are putting less than 20% down, you need to pay an insurance company PMI to cover the extra risk of your loan. PMI is paid in three very different ways: a monthly payment calculated as a small percentage of your loan amount, or a lump sum payment paid when you secure the loan, or simply a higher mortgage rate on the entire loan amount. For most conventional loans, you can choose to pay an upfront lump sum to eliminate the need for monthly payments. And with some jumbo loans, typically 30-year fixed loans with loan amounts above the so-called conforming limit, the rate on the entire mortgage is increased rather than having a separate PMI payment. For conventional loans, the less you put down, the higher your PMI payment. The increase is a step function where increases occur at 5 percentage point intervals. In other words, there is one PMI rate for down payments between 15 and 20%. PMI increases for down payments between 10 and 15%, and so on. The PMI cost also varies depending on your credit score and debt to income ratio. And there are discounts for PMI if you qualify for some first-time homebuyer programs. Generally speaking, monthly PMI payments are automatically eliminated once you pay your loan amount down to 78% of the original purchase price or appraised value of your home. You can sometimes eliminate the monthly PMI sooner if your home is appreciated and/or you have paid extra principal on your mortgage. There are other types of loans that have very different types of mortgage insurance. The most common alternative is insured by the Federal Housing Administration, or FHA. All FHA loans carry a fixed monthly mortgage insurance fee based on a percentage of the loan amount that changes only a little bit for larger down payments. And unlike conventional loans, FHA loans require monthly mortgage insurance payments even if you put down 20% or more. For FHA loans, this is called monthly MIP, or mortgage insurance premium. The insurance is provided by the government and not a private entity, which is why it is not called PMI. FHA also has an upfront mortgage insurance premium of 1.75% of the loan amount that can be rolled into it. Conventional loans do not have this fee. FHA mortgage insurance cannot be eliminated for at least 11 years, and for FHA loans with down payments of less than 10%, the mortgage insurance must be paid forever. Finally, unlike conventional loans, you cannot petition to have your mortgage insurance removed. The difference between MI for FHA and PMI for conventional loans is complicated. Here is a summary of the differences. Generally speaking, FHA is likely a better deal if you have a below average credit score and a down payment of less than 20%, but it's always worth checking both programs. That said, I will say that FHA loans can be deceiving. While they often carry lower mortgage rates than for comparable conventional loans, the fact that there is mortgage insurance that in most cases cannot be canceled and an upfront fee of 1.75% of the loan amount that is not required for conventional loans means that in many cases the conventional option is better, even if the FHA loan has a lower rate on the base mortgage. There are other types of mortgages that are offered to more limited groups of people, like VA loans, which are only available to the military, veterans, and their spouses. Many of these specialty mortgages have better deals on mortgage insurance than conventional and FHA loans. The bottom line is the rules governing mortgage insurance are complicated and vary across different mortgage products. Work closely with your mortgage loan officer to figure out the best option for you. And please watch my video, How to Get Rid of PMI, to get a better understanding of how to eliminate PMI if you have a conventional loan that requires it. I hope to see you again soon.